Every publicly traded company on Earth is required to publish its financial statements. That information is free, it's updated every quarter, and it tells you almost everything you need to know about what a business is actually worth. And yet most investors never look at it. They follow headlines, listen to analysts, react to stock price movements, and completely ignore the one source of information that has the best chance of telling them what's really going on inside a company. Reading financial statements isn't as complicated as it looks. The language is technical, but the concepts underneath it are straightforward. Once you understand what you're looking at, you can open the financials of any company, Apple, a small regional bank, a retailer you're curious about, and form a genuinely informed view of its health, its value, and whether the stock price reflects reality. That's what this video is about. By the end of it, you'll know how to read the 3 core financial statements, what to look for in each one, and how to use that information to estimate what a company is actually worth. Welcome to Global Finance Watch, where we break down the strategies, trends, and decisions that drive real financial outcomes. Subscribe if you haven't. New videos every week. Let's start with some context on why this matters. When you buy a share of stock, you're buying a fractional ownership stake in a real business. That business has revenues, expenses, assets, debt, and cash flow. The price of the stock goes up and down every day based on what the market thinks the business is worth. But the market isn't always right. Some of the greatest investors of all time, from Warren Buffett to Peter Lynch, built their fortunes by identifying gaps between what the market thought a company was worth and what the financial statements showed it was actually worth. You don't need to be a professional analyst to do this. You need to understand 3 documents: the income statement, the balance sheet, and the cash flow statement. Each one answers a different question about the business. The income statement answers, is this company making money? The income statement, sometimes called the profit and loss statement, or P&L, shows you what a company earned and what it spent over a specific period, usually a quarter or a full year. The top line is revenue, sometimes called net sales. This is the total amount of money the company brought in from its core business. When you hear someone say a company grew revenue 15%, they're talking about this number. From revenue, you subtract the cost of goods sold, the direct costs of producing whatever the company sells. What's left is gross profit. Divide gross profit by revenue, and you get the gross margin, expressed as a percentage. Gross margin tells you how efficiently a company converts sales into profit before overhead. A software company might have a gross margin of 70% or higher. A grocery store might run at 25%. Neither is automatically good or bad. What matters is whether the margin is healthy for the industry and whether it's trending in the right direction over time. Below gross profit, you subtract operating expenses, things like salaries, marketing, research and development, and administrative costs. What's left is operating income, sometimes called EBIT, which stands for earnings before interest and taxes. This tells you how profitable the core business operations are before financing costs and the tax bill. After interest expenses and taxes are factored in, you arrive at net income, the bottom line. This is what the company actually earned as profit. Divide net income by total revenue, and you get the net profit margin, which tells you how many cents of profit the company keeps for every dollar of revenue it generates. One important thing to understand about the income statement, it's built on accrual accounting, which means revenue is recognized when it's earned, not necessarily when the cash arrives. A company can show strong net income while actually running out of cash. That's why the income statement alone isn't enough, which is exactly why the cash flow statement exists. The balance sheet answers, what does this company own and what does it owe? The balance sheet is a snapshot of the company's financial position at a single point in time. It's organized around a fundamental equation: assets equal liabilities plus shareholders' equity. Every dollar of assets is funded either by debt the company owes, or by equity that belongs to the shareholders. On the asset side, you have current assets, things that can be converted to cash within a year. Cash and cash equivalents, accounts receivable, money owed to the company by customers, and inventory. Then you have long-term assets, property, equipment, patents, and goodwill, which is the premium paid above the book value of an acquired company. On the liability side, current liabilities include accounts payable, short-term debt, and other obligations due within the year. Long-term liabilities include bonds, long-term loans, and pension obligations. Shareholders' equity, sometimes called book value, is what's left over after you subtract total liabilities from total assets. It represents the theoretical value that belongs to shareholders if the company were liquidated. A few ratios from the balance sheet are worth knowing. The current ratio divides current assets by current liabilities. A ratio above 1 means the company has enough short-term assets to cover its short-term obligations, generally a sign of financial stability. The debt-to-equity ratio divides total debt by shareholders' equity, giving you a sense of how leveraged the company is. High leverage amplifies both gains and losses. A company with a debt-to-equity ratio of 0.3 is conservatively financed. One with a ratio of 3.0 is carrying significant debt relative to its equity base and is more vulnerable if business conditions deteriorate. Also pay attention to the cash position. How much cash and equivalents does the company hold? Companies with large cash reserves, think of Apple sitting on hundreds of billions, have enormous flexibility. They can weather downturns, buy back stock, make acquisitions, or pay dividends. Companies with thin cash reserves and heavy debt are exposed. The cash flow statement answers, is this company actually generating real cash? This is the statement most retail investors overlook, and it's arguably the most important one. The cash flow statement shows you the actual movement of cash in and out of the business across 3 categories: operating activities, investing activities, and financing activities. Operating cash flow is cash generated by the core business, not accounting profits, but actual dollars flowing in and out. This is the number that cuts through the accrual accounting of the income statement. A company that shows strong net income, but weak or negative operating cash flow is a red flag. It might mean revenue is being recognized before customers actually pay, or that the business is consuming more cash than the reported earnings suggest. The investing section shows cash spent on capital expenditures, buying equipment, building facilities, acquiring other companies, and cash received from selling assets. High capital expenditure isn't inherently bad, but it tells you something about how asset-intensive the business is. A software company that generates $1 of revenue with very little capital spending is fundamentally different from a manufacturing company that needs to constantly reinvest in equipment. Financing activities show cash raised or returned through debt and equity. Issuing new stock raises cash but dilutes existing shareholders. Paying down debt reduces cash but strengthens the balance sheet. Share buybacks return cash to shareholders and reduce the share count, which increases earnings per share. The number at the bottom of the cash flow statement is free cash flow, generally defined as operating cash flow minus capital expenditures. This is the cash the company genuinely has available after maintaining and investing in the business. Free cash flow is what funds dividends, buybacks, debt repayment, and acquisitions. It's one of the most important numbers in all of financial analysis. Now, how do you use all of this to estimate what a company is actually worth? The most widely used framework is called a discounted cash flow analysis, or DCF. The concept is straightforward. A company is worth the sum of all the cash it will generate in the future, discounted back to what that cash is worth in today's dollars. Future cash is worth less than present cash because of inflation, risk, and opportunity cost. The discount rate you apply reflects those factors. In practice, you take the company's current free cash flow, Project how it will grow over the next 5 to 10 years based on historical growth rates and your assessment of the business. Then apply a terminal value that captures the company's value beyond your projection period. Discount all of that back to today, and you get an estimate of intrinsic value. Divide by the share count, and you get intrinsic value per share. Compare that to the current stock price, and you can see whether the stock looks cheap, fairly valued, or expensive. DCF analysis requires assumptions that will always be imperfect, and small changes in your growth rate or discount rate can meaningfully change the output. Professional analysts spend careers refining these models, but even a rough DCF gives you a framework for thinking about whether a stock is priced at a premium or a discount to what the business is likely to generate over time. For a faster, less model-intensive approach, valuation multiples give you a quick benchmark. The price-to-earnings ratio, or PE, divides the stock price by earnings per share. If a stock trades at a PE of 15, you're paying $15 for every $1 of annual earnings. Comparing a company's PE to its historical average and to competitors in the same industry tells you whether it's trading at a premium or a discount. The price-to-free cash flow ratio does the same thing with free cash flow rather than reported earnings, which many analysts prefer because it's harder to manipulate. The price-to-book ratio compares market value to the balance sheet's book value and is particularly useful for financial companies. No single multiple tells the full story, but taken together, alongside a solid reading of the 3 financial statements, they give you a grounded, evidence-based view of a company's value, one that's anchored in the actual numbers rather than the noise of daily market movements. Let's bring it all together. The income statement tells you whether a company is making money. Revenue, gross margin, operating income, and net profit margin are the key figures. The balance sheet tells you what the company owns and owes. Current ratio, debt to equity, and cash position are your anchors. The cash flow statement tells you whether the business is actually generating real cash. Operating cash flow and free cash flow are the numbers that matter most here. And to estimate what the company is actually worth, you use either a discounted cash flow model for a detailed intrinsic value estimate, or valuation multiples like PE and price to free cash flow for a faster benchmark. These skills don't make you infallible. Even the best investors in the world get it wrong sometimes, but they give you something the majority of retail investors don't have: a factual, grounded basis for the decisions you make. That's a meaningful edge, and it starts with knowing how to read the statements. If this was useful, drop a comment below with the company you want to analyze first. Subscribe if you haven't, and check out our videos on investing in stocks for beginners and how investing works if you want to build on what we covered here. We'll see you in the next one.